The Bank of England, established in 1694, although the bank was originally a private institution, but by the end of the 18th century it was increasingly being regarded as a public authority with a civic responsibilities toward the upkeeping of the healthy financial system. The currency crisis of the 1797, caused by the panicked depositors withdrawing from the banks, led to the government suspending convertibilities of the notes into the specie payments. The bank was soon accused by the billionists of the causing the exchange rates to fall from our issuing banknotes, a charge which the bank denied. Nevertheless, it was clear that the bank was being treated as an organ of the state. Henry Thornton, a merchant banker and a monetary theorist, has been described as the father of the modern central bank and opponent of the real bills doctrine. He was a defender of the billionist position and a significant figure in the monetary theory. His process of the monetary expansion anticipated the theories of the convection regarding the cumulative process, which restated the quantity theory in a theoretically coherent form. As a response of 1797 currency crisis, Thornton wrote in 1802 an inquiry into the nature and the effects of the paper credit of the Great Britain, in which he argued that the increase in paper credit did not cause the crisis. The book also gives a detailed account of the British monetary system, as well as a detailed examination of the ways in which the banking of the England should act to counteract fluctuation in the value of the pound. Walter Bagehot, an influential theorist on the economic role of the central bank. Until the mid-century, 19th century, the commercial banks were able to issue their own banknotes, and notes issued by the provisional banking companies were commonly in circulation. Many considered the origin of the central bank to lie with the passage of the Bank Charter Act of 1844. Under the 1844 Act, bullionism was institutionalized in Britain, creating a ratio between the gold reserves held by the Banking of the England and the notes that the bank could issue. The Act also placed strict curbs on the issuance of the notes by the country bankers. The bank accepted the role of the lender of the last resort in the 1870s after the criticism of its lackluster response to the hour-end Gurney crisis, and the journalist Walter Bagehot wrote an influential work on the subject, Lambert Street, a description of the money market, in which he advocated for the bank to officially become a lender of the last resort during a credit surge. Central banks were established in the many European countries during the 19th century. The War of the Second Coalition led to the creation of the Banque de France in 1800 in an effort to improve the public financing of the war. This U.S. Federal Reserve was created by the U.S. Congress through the passing of the Federal Reserve Act 1913. Australia established its first central bank in 1920, Colombia in 1923, Mexico, Chile in 1925, and Canada and New Zealand in the aftermath of the Great Depression in 1934. And by 1935, the only significant independent nation that did not possess a central bank was Brazil, which subsequently developed a prosecutor thereto. In 1945, the present central bank, 20 years later, having gained independent, African and Asian countries also established central banks or monetary union.